Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have Jon Cukiewar. Did I get it?
You got it right. You nailed it.
Got it right. Jon is the founder of Sohra Peak Capital. What is it?
Sohra Peak Capital.
You're just really testing. Anyone who's listened to me for a while knows I'm not great at pronunciation, and you are just really testing all of it. But Jon, how's it going, man?
Oh, it's going great, Andrew. Thanks so much for having me on. Really appreciate the time.
Hey, I appreciate you coming on. And let me start this podcast the way I do every podcast. First, I'm going to give a disclaimer. Nothing on this podcast is investing advice. We're going to be talking about a Canadian stock today, about a 3 billion market cap company. But, Canadian stock, there are some regulatory risks here. So everybody should just remember a little bit of extra risk for domestic listeners. Please do your own due diligence. Nothing on here is investing advice. And then the second way I started a podcast is with a pitch for you, my guest. We've chatted a few times. I found you to be very sharp. I'm really excited for our listeners to get it. But I think the best feedback I can give you is you just started your firm, we'll call it. But I know some people who knew you in a prior life. I kind of did some due diligence on you, and all of them spoke extremely highly of you. So, I'm sure the fund is going to be a great success, but we've got great background checks. I find you to be sharp. So I think our listeners are really going to enjoy this one. So they can look back on this pod and say, they heard the first interview with you before you hit it big. So that out the way, let's turn to the company we're going to talk about today. This is a Canadian company. The company is goeasy. They trade under the symbol GSY up in Canada. And I'll just flip it over to you, Jon. What's so attractive about goeasy?
Yeah, thanks, Andrew. So goeasy, it's one of my favorite holdings. And, disclaimer, I am long the position. And as Andrew said, do your own due diligence. It's one of my favorite companies, and I'm very happy to give, the full rundown, a background of the company, their story, kind of a run through of their products, their customers, some of their key competitive advantages, the addressable market that they're targeting, which is quite large, and kind of the vision of, what the future is going to hold for this company. And it's a very long-term thesis. So, we're talking, these operators can probably continue compounding this company for many years, if not at least a decade. So, let me start kind of an overview. As you mentioned, $3 billion company trading in Canada, Toronto Stock Exchange. And, they've had kind of a very good run over the past decade. They have compounded earnings per share at about 30% since 2011. And
I'm laughing because Jon says good run. And I was telling him before the podcast, I had some random notes, and they're like 15x over the past 10 years. And I have some random notes.
Something like that.
When they were 10x ago. So good run might be a little overstatement, but sorry to jump in. Please go ahead.
So quite a good run. I think if you take like the very, very lows in the early 2000s, it's maybe closer to 100x. Don't quote me on that. But so anyway, they've had a good run. Operating margins have expanded from 8% to 33%. And, so the story begins back in 1990. RTO Enterprises, totally different business than what it was today. They were founded, and it was a mixture and variety of rent to own businesses. So you think like Aaron's, you think, Rent-A-Center, these furniture companies where you go in and you can rent a piece of furniture and, you pay pretty high interest rates on it. And you have the option at the end to buy the furniture, or after a certain amount of time, you can give it back. So they operated like a mixture of those brands. At some point, like I think in the early 2000s, around 2001, they consolidated that into their strongest brand called Easy Home, right? And they retitled the company called Easy Home in 2001. Now, around 2000, there was the current chairman, Don Johnson. He took over as chairman of the company. And he hired at the time the CEO at the time called David Ingram. He's now also, one of the chairmen, and we'll get into the progression. And so David Ingram took over as CEO around 2001. And so he operated this business, this Easy Home business, and, he was opening more branches. He was organically growing the company. And then, something very interesting happened in the industry, and which paved the way for goeasy and, a few other competitors, but, mainly goeasy's capitalized the most to really achieve the success they had today. So in 2008, the great financial crisis happened. We all know. So specific to this industry, in Canada, there were three giants leading up to the great financial crisis who were operating in the installment lending space, which means, they have branches and consumers come in, non-prime consumers, and they say, hey, I need a loan, but I don't have prime credit. I'm willing to take, hundreds or a few $1,000s at, a slightly higher interest rate, higher interest rate than most people would pay. And they say, okay, so this business goes back all the way to the 1920s, right? I think HSBC and Wells Fargo have their roots many, many years back. So they've been building their books of businesses for up to 100 years, right? There's HSBC, Wells Fargo, Citi Financial. And, they have, I think in total, at least a few hundred branches. Each of them, the average loan size of the branch is over $10 million. Now, the great financial crisis happens, and it was a combination of two things, right? One, there was new Basel III requirements, and these banks now had to, have certain requirements for the assets that they have in their balance sheets, right? And these loans, because of the way they were classified, and they're classified as risky, and they need to hold more reserves, that puts some pressure. And then, the other bigger point was from a PR standpoint. These banks were just, deemed culpable and responsible for blowing up the global financial system. It was because of non-prime mortgages. And now here they are in Canada with, a total of $3 billion of loans to these non-prime people. And it just was not a good look. So these banks said, you know what, we have, billions, trillions of dollars dispersed elsewhere. We're going to wind down these businesses. It's a $3 billion book. So HSBC wound down and ran off their entire book. They shut down their branches. They sold their loans. Wells Fargo did the same exact thing over the span of about 2 to 3 years. And Citi Financial, they did a combination of a runoff, and then they sold their remaining book, the remaining assets in 2016, which is now called Fairstone. And they're kind of the other big competitor in the industry. And so going back to goeasy, who at the time was called Easy Home, their CEO, he saw this opportunity and he saw, wow, so there was a 100-year-old industry that suddenly, like overnight, of the span of 1 to 2 years, just disappeared. But the thing is, these customers, and I'll get to it in a second of who exactly these customers are, these customers still have high demand for this product, and they need to go somewhere for these loans. So he decided in 2011, he'd been operating the product, kind of tinkering for a few years in the Easy Home branches. In 2011, he opened up the first dedicated Easy Financial branch. And so in Easy Financial, just very quickly, like they offered unsecured loans to people with non-prime credit, people who have credit that's not quite prime, so they're not good enough to go to a bank and traditional sources to get their loans, but they're better than subprime and deep subprime, so they don't want to go to a payday lender and pay 300%, 500% APR, for a loan. And also, payday lenders typically have loans under $1,000. These people might need up to, $5,000, $6,000, $10,000. So anyway, this niche still existed, and Easy Financial was born. And so Easy Financial, they rolled out, one branch, they rolled out a handful of branches. They were seeing remarkable success early on. And then another thing happened. And this I really give credit to, to David Ingram and Don Johnson, the two current chairmen, and he was CEO at the time. David Ingram they went to the company and they went to the board of directors. They said, look, this Easy Financial product, we think this is the future of the business. We need to go down this direction. And the rest of the board of directors said, no, we don't, you want to kind of lever up this business and you want to open new branches and you want to explore in this territory. We've had this other business that we've been running for over 20 years. And so the end result was that the only backing that the CEO got was from the chairman. So the chairman and the CEO together, they stuck their ground, they held their ground, and the rest of the board resigned. So the rest of the board, look it up. There was one board member who stuck with them, the chairman, the CEO, but the other 5 out of 8, they resigned. They just stepped down.
If I can just jump in, I mean, obviously hindsight 2020, the strategy was completely successful, but it's funny you say that because GSY has had a short thesis out there that's proved pretty wrong. I would say the share price, who knows, maybe something bad happens, was proved pretty wrong. But if I was just looking at this from the outside and I saw a company where 5 of the 8 directors resigned in protest of a strategy, I mean, I can't, I don't short much anymore because of meme stocks and everything, but that would be the biggest red flag. And it's just such a cool story, but continue.
Yeah. Can you imagine the posts on Twitter, like from some of the big shorts? So yeah. So that happened. And so, they held their ground over there. So fast forward, they started just building out more branches. So the end result was they started with 1 branch and now they have about, 250 Easy Financial branches. So, kind of going back, what exactly is the product they offer? And who exactly are the customers that is their target customer? So their target customer, is these non-prime people. And, just to give you more of a sense of, the world they live in and how they compare to the typical person is, as we mentioned, they have non-prime credit. So they can't go to banks, right? Like you and me, if we need access to credit, Andrew, we can go to a bank, many banks, and we can, work something out. I have a Chase Sapphire Reserve credit card, and, I have prime credit. My credit limit is in the tens of thousands.
Let's not brag too much over here though, Jon.
Okay. Well, I thought that was pretty standard. So, so the point being, like, I have access to credit should I need it, should, like, my car break down, should, I need a home repair, should I need to, consolidate debt or pay my bills, or I have some like unexpected crisis in my life. But a lot of people, if you have non-prime credit, you don't have access to these banks. You can get a credit card, but a lot of credit cards for people with FICOs of like from between 500 and 600 in that range, their maximum limit is like $300, maybe $500.
Yep.
Their APRs are in the 20s and 30s, and but also they have a lot of fees and late fees they have to hit. But more importantly is the ceiling, right? And then their other alternatives are friends and family, which people do go through and run through those people. And then payday lenders is kind of the last resort. And again, like, do you want to borrow $500 and when you may need 5,000 and pay 200% APR in that, you have to pay back in 2 weeks? Probably not. That's not the best source of capital. So when they go to goeasy, right, 72% of them already have, like credit cards. 40% of them already have at least one payday loan. goeasy is kind of a lender of last resort. And so they're seeking loans typically between $500 and $10,000. That's for kind of on the unsecured spectrum. I actually think it's 500 to 15,000, but that's on the unsecured loan spectrum. Unsecured meaning like there's no collateral, and so the person, like if they charge off and they can't pay it back, that's just a risk that goeasy is taking. Obviously, they have a collection process, but
just quick question here. 500. So. And I'll mention this in a few minutes, but I'm familiar with some of these in the US, and 500 to 2,000 is quick auto repairs, medical bills, that sort of stuff. But you mentioned that these go up to 10 or even 15,000. I'm just curious, what would someone need 10 or 15,000 on an unsecured kind of emergency basis? I mean, it's Canada, so I think they've got government healthcare up there. So I'd guess the emergency medical procedures are a little bit lower. So I'm just trying to think of the bigger ticket loans. What are those coming from?
Yeah, sure. And so the average loan size is around $6,400 for the unsecured. Yeah, so I mean, like the at least the top reasons they cite are auto repairs, home repairs, bill payment, and debt consolidation. Debt consolidation could very well be, like one of the major items. So those are the big. So I guess if your car breaks down and you need like a $5,000, repair, like a pretty big thing, or maybe you just want help, like to buy a new car, or a new used car. Something along those lines, or a major something happens in your home and and you need to pay a few $1,000s, and another unexpected life crises. But I think also these people, like, sometimes I think they do have payday loans that they've racked up interest. They do have credit card loans that they've racked up 1,000 here, 1,000 there, and they just want to consolidate it sometimes and just pay it down and only have one debtor who's goeasy. Yeah.
Cool. No, that's perfect. Please continue, or I can start getting my questions, but I think you had a little bit more on the goeasy background.
Yeah. So just in the background for sure. And then they also offer, by the way, like a secure product right now. And secure goes from 15 all the way to 45,000. Actually, they're longer term in nature. They are typically between 6 and 10 years in tenor. And they are secured against your home. So, it's only for people who have a house. About 20% of consumers who come in, they have a house. And so those people are eligible for those loans. And, the trade-off is, the unsecured loans have average interest rates right now of in the low 40s. And in the secured loans, it's more in the mid, low to mid 20s right now. So, and on a blended basis, the company has, an average interest rate. I think 3 years ago, it was 54%. It's come down to 41%. So, and one reason they're trying to get the rate down is, I think, just trying to get ahead in case there's any federal government regulation, which I think the cap is at 60. That's like it was one bear case. There was one bear thesis on Seeking Alpha a few years ago, like, oh, they might lower the cap, but it was all, hot air. But 60%, and they're at 41, and they just made an acquisition. They're going to bring it even lower. Anyway, I think that risk is pretty much a non-event right now. But so that's kind of the background on who their customers are, their loans, and then from there. Anyway, if you have a few questions, we can definitely get to them.
Yeah, no. So, that was great background. I mean, that's the stuff of somebody who's you followed this stock for 20 years. That was an awesome background. I guess when I look at this company, I'll just jump straight into my two major questions when I was researching it. The whole time I'm researching it, and the first thing that's popping to my head is goeasy at, I'm just going to call it $200, is trading at 6 times price to book, 30 times earnings per share. And we'll discuss the financial metrics in a second, but they probably deserve that, right? They're growing quickly. Returns on equity are 20 to 40%, depending on if you include the goodwill. Returns on assets approaching 10%. I mean, this is an incredible business with incredible returns. But when I kind of think opportunity set or opportunity cost or comp set, I look at the US businesses, right? And like Elevate Credit is trading, that's more payday than subprime, but they're trading at, a fraction of book. They've got great metrics, but they're trading at a fraction of books. Something like OppFi, which I discussed with Kyle Sermonaro, the SPAC sponsor there, that has a very similar story where they say, hey, we're not payday lending. We're not prime lending. We're kind of hitting the people in the middle, and they do a little bit smaller loans. They're more focused on $500 to $2,000 checks, but that right now, it de-SPACed and it's traded down 20%, and it trades at 9 times EBITDA, something like that, despite great growth metrics. So I guess my first thing is, this is Canadian, but why is this trading at such a big premium when kind of US based competitors trade at such a big discount? And that'll probably bring us into regulatory, which I'll follow up with a question on regulatory.
Yeah, absolutely. And so I'm sure a lot of these, US businesses you're mentioning, they are trading at optically cheap multiples. I don't know a ton about them. They do offer and operate in very different spaces, I think, for two main reasons. One, a lot of them are primarily online, and online lending, and the branch-based, omni-channel lending, and especially kind of the long-term vision that goeasy has, and which will make it a very differentiated model, is one difference. And the other is that, as you mentioned, like they're in payday lending, single pay territory, where these loans are they last maybe weeks, I don't know, maybe months sometimes in nature, and much higher interest rates. And there's a whole different set of economics that come along with that, right? You have if it's more of a in the end, also the US, there's one structural reason the US tends to have more commoditized product, because the companies without records of data and histories of data have more easy access to credit from to data from the credit bureaus on like people and their payment histories and this and that, which doesn't exist in Canada. So a startup can a lot more easily, get, better pricing, better algorithms, and better underwriting compared to the existing players. And so, customer acquisition costs and especially, provision rates are very different for payday lenders, so the whole margin structure is very different. Again, those could be home runs, and those could be way better investments than goeasy is today. I simply, I haven't, it's not something I've spent an awful lot of time on in the US. But I will certainly, tell you about goeasy, but sorry, go ahead.
No, it's just, look, investing is a game of conviction, right? And if obviously you've done the work on goeasy. So if you're convicted on goeasy, there's no reason you need to go and look at these other guys. But that was just the first thing that jumped to my mind. I guess second thing, and then we'll go to regulatory. Just going back to the numbers, returns on assets are approaching 10%. Returns on equity, 30%-ish or something. These are crazy numbers for a company that lending is a commodity, right? You're giving people money. Money is the ultimate commodity. They don't care if they're getting it from me or you. They really just care about, are they getting the best rate, the best terms, when they need it, all that type of stuff. When they need it, I think it does a lot of work in that sense for a subprime lender, but still it does strike me as a little bit crazy that I heard you on Wells Fargo and all these other guys withdrew, but it does strike me as a little bit crazy, like lending money, 40% ROE, it's just very high. So how is nobody coming and competing with these guys? How is, why don't you and I go start up a loan like this and do this type of thing? Why haven't banks moved back in? I mean, 40% returns on equity with 10% ROA, like you can take a lot of Basel hits and still make a lot of money on a lot of big capital charges if you're a big bank, and still make a lot of money on this type of lending.
Right. So I think first and foremost, I do think those ROA and ROE numbers are inflated. They probably include that gain on sale or gain on investment, that they had this year.
You might be right. You know what? I do think I was using their adjusted numbers though, because for viewers who want to get into the week, if you go look at their financial statements, and I love this, right? They say like, hey, in the LTM, our EPS was 10, but that included a gain on sale. I believe they sold a small investment to Affirm or Afterpay, one of the BNPLs, and they actually back that up, right? They say our EPS is 10, but our adjusted EPS was 8. And I think I'm using their adjusted numbers, but I'm not 100% positive.
Right. So either way, I mean, their numbers are high. Kind of, I think in a unit economic model, like if you start with like $1 lent out and 41% average interest that they receive and 13%, or sorry, now it's 9% average like charge off, and then their interest rate is below 5%. If you kind of work down the margin math, you get to about 10% kind of normalized return on capital, 23% return on equity, still very high. So yeah, so how does this exist? How does this exist, and why does this exist? It's a very good question, and it's something that after a lot of studying, I feel pretty confident about. I think there's a couple barriers to entry. Then I think there's also a couple very significant kind of competitive advantages that the company holds. The first couple barriers to entry are just functions of them being in the business for so long and having built up the business to what it is today. The first being is, if you just look 3 years ago, 2017, 2018, they issued like a series of unsecured notes for 7.9%. And so they were paying, almost 8%, and I think back, and if you look in the Easy Home days, they were like paying like 12%, 13% for their unsecured notes. If you're just starting out and you're lending, like this is a tough business. Most companies don't make it. And the banks, like they know this and they charge you a lot for your debt. Now, because they've proven the strength of their model, they've proven the resiliency of their model, they've gotten their interest rates, all the way down to, the blended is right now, I think 4.6, 4.7%. It's really low. And so, so first of all, new entrants, who are going to be paying, 5, 6, 7, 8% above, an interest than what they do, that's a whole, then that's money you either have to make it up somehow, or you're just going to earn way lower profits. Again, like these guys, when they first started Easy Financial, their operating margin was like 8%. So, 5 to 8% could alone, like, that makes a big difference. Anyway, the other reason being they've been around for so long, they've done tons of advertising, they have 250 Easy Financial branches and 150 Easy Home branches. So like 400 billboards all across Canada, you could call it, where people it's like ingrained, and, the consumer awareness is very high of people in that segment. So anyway, it's also that brand power. You could buy, somebody with very deep pockets could build, tons and tons of branches, but also like you need a lot of time and many years to kind of get that in people's heads. As far as the competitive advantages, I think there's two things that really, really would make it difficult for you or I to go in and just earn 40% ROEs and like eat their lunch. The first is that they have a very, a big trove of data that they've accumulated from underwriting. I think at this point they've originated like billions and billions and billions of dollars of loans. On a cumulative basis, I think it's between like 5 and 10 billion. This year, they're going to originate like $3 billion alone. And the only existing competitor that has more history is Fairstone, because like they're the legacy of of City Financial. And by the way, Fairstone can't really compete in the same way they used to. They used to be kind of like neck and neck, because they got acquired by Duo Bank, which is a merchant bank in Canada. And now they're subject to all of those rules and regulations that banks are subject to, right? Like the Basel regulations,
let me give you a pushback there then, right? So Duo Bank, when they acquired Fairstone, I'm sure they knew they were subject to all of these rules and regulations. So why would they go, it comes back to, if banks aren't getting into the space, right? But Duo Bank just bought this company. Why would they buy them when they knew that they were going to be subject to all of these rules and regulations?
Right. They bought them because they did receive an advantage that that I need to look out for, is that their rate of borrowing went from like 5% to between 1 and 2%,
because they can use deposits. Exactly. Yeah,
exactly. So that's the advantage. That is the advantage. And also, like, why would Fairstone sell? They were actually owned by private equity. And so, like JC Flowers, and I think, one other company. And then, so it was, being private equity managed, which, by the way, when a company is being managed by private equity, they're not necessarily have the consumer in mind. It's more slashing costs and optimizing profits for an exit. Anyway, look, point being, if I'm worried about any competitor in the industry, it is definitely Fairstone. And that's goeasy has their like laser focus on them. But, thankfully it's a massive market, which I'll definitely, get into and touch on. So there's more than enough space for the two of them. So, besides those two, right, like they have all this data. So what I was saying earlier, in the US, what you can do is, if you're an entrant, you can, from the credit bureaus, you can buy data on consumers. You can see, like in addition to seeing what their payments are on debt, you can also see information like, the history of payments on utility bills, like their electric or their water bills, things like that. And there's other data that you can receive. In Canada, the basic privacy laws are a lot stricter. So if you're starting out, it's actually, and who told me this was the CFO of Curo, actually, he told me this on a conversation was, the between the US and Canada, Canada is like a lot stricter. So therefore, it's all that much more important to have your own data and underwriting. And, it makes like worlds and worlds of difference if you're starting out, right, for goeasy. Like even they talk about how far they've come in only the last, 3, 4, 5 years alone. Every year is like so much better and better. Even just over the past couple of years, they've started to use like machine learning to, buzzword and not overstating anything, but just to, kind of like comb through their data and make it as good as they can. Because the better underwriting you have, the lower your charge-offs on average, the higher probability the customer is not going to default or have to refinance, and you can optimize the rates. It's a hard business. It's a really hard business. And so, also what is also kind of should be understood is that credit scores in general are good at predicting payment behavior for prime customers, but they're really bad at predicting credit payment behavior for non-prime customers. So again, people say, oh, just use the credit score. And that's really good if you have prime, if you're like 680, 700 plus. But if you're non-prime, like the correlation is very low. It's insignificant. So if you consider FICO, or the Canadian equivalent, means nothing. And if you don't already have your own stockpile, like it's a total guess. It's totally random, and you're kind of screwed. So then, the other thing I kind of mentioned is, and this is, this is, I guess, up to more interpretation, but I think management and the skill of management, their track record and the vision is definitely a big strength of goeasy. And it's probably the biggest reason why I have confidence, going forward. As I mentioned before, they have a chairman, David Ingram. He was there from 2001 to 2019, 18 years as a run of CEO. And he groomed the current CEO for 7 years. This guy named Jason Mullins, he worked his way up to become the COO of the company. And kind of the way he worked his way up and he caught the eye of David Ingram, was a funny story. And he caught fraud that was going on in one of the Easy Home branches, and he became a rising star at the company. But anyway, he was groomed by that guy. And, with David Ingram, if you ever sit down with him, he's one of these guys that you just think in your mind, I don't want to bet against him. He really leaves like a deep impression of you, in you. And so anyway, he's chairman. He still has over $50 million invested in the company through his shares. And by the way, the other chairman, Don Johnson, has like over $400 million. These guys there's like 26% inside ownership, very deep skin in the game. And the current CEO, so he's there, the chairman still views the company as his baby, and he's still very much involved. So they're kind of like maybe a tag team, with obviously the CEO having more responsibility. And Jason has done an incredible job. Jason Mullins, incredible job so far. Like, you think of some of the things he's done so far. He really took initiative on the secured loan product to make that a bigger part of the portfolio. He introduced like an auto loan product. We'll talk about that, as well. He, has really tried to improve the quality of the data and the underwriting. He took the minority interest stake in PayBright, which turned into a stake in Affirm. Talk about as well as far as TAM. Anyway, and he just acquired lendcare, which was kind of very significant. And, they acquired that at 7 times 2023 earnings. Anyway, Jason is extraordinary. When you talk to him, he's always hungry to innovate products. They're always thinking, years and years ahead. And he's incentivized also in order to maximize his bonus and to compound earnings at 30% a year, on a trailing 3-year basis. So he needs, if you look at trailing 3 years, like the average of that earning growth needs to be 30%. Again, that's good. And that's also might be the biggest risk in the company, by the way, of just, management, trying to reach the numbers. And
that was actually the next thing that was maybe not the next thing, but I had that on my list of questions. But one thing you didn't say there, which I was just flipping through to their annual report to confirm I was right. The other thing they did is in 2020, they bought back a lot of $42 million worth of stock, which I think their average market cap last year was under $1 billion. So that's a significant amount of stock at $55 per share. And as you and I are talking, this is almost a $200 per share stock. So, this is a financial, and I don't know a lot of financials that bought back stock in 2020. And in particular, I don't know a lot of financials that bought back stock pretty aggressively in 2020. So, that is the sign of some very shareholder friendly and very astute capital allocation.
I would agree with you there. I'll even knock management a little bit. The only knock I have on the company and them is that, they've become much better at repurchases. And I think to what you're saying, I agree. It's a good sign of capital allocation. Is the only knock I have is they've been paying dividends regularly and at a pretty high rate. They've increased it to 35% of trailing earnings. And it's I disagree with that, because I think, look, if you look at what this business has done, they've reinvested 100% of their otherwise free cash flow into the business to grow, their loan originations, to compound earnings, to compound, their book. And this business, obviously the results speak for themselves, and it's been a huge success. But unfortunately, along the way, because of the dividends that they've paid out, they have had to raise a lot of equity. They've diluted shareholders. And if you do the basic math of, all those, tens, hundreds of millions of dollars of dividends that, maybe they've issued over the last, the history of the company, especially the last 10 years, if they'd taken that and just bought back their shares instead, and, both of the chairmen have a lot of stake in the company. They own a lot of shares. Can you imagine? I mean, the share price, I don't know what the math is, offhand. I've definitely done exercises, but it would be significantly higher than it is today. We could be talking like a $400 company, $500 company.
And even more, again, my mind's blown. 20-30% returns on equity. Like when you're a financial with 20-30% returns on equity, you maybe, if your shares are trading very cheap, maybe you consider buying back. But I don't know many companies that have that type of return and say, hey, you know what we want to do? Send some money out the door to our shareholders. Like most of them would be like, let's plow this all back into growing this business. You've mentioned how you think they might have a little bit of a, I guess I call it data moat or data flywheel, where they do more loans, they get more data, but they're just getting incredible returns. So the dividend is a little bit weird. You started to allude to it, but let me ask you, anyone who's invested in financials before knows the biggest red flag for a financial is a financial that's growing quickly, right? Because if financial grows quickly, it generally takes a couple years for for bad loans to kind of come back to bite you. That might not be the case here because these are unsecured shorter term loans, so you probably work through the book quicker. But the financials that are growing quickly is commonly known as, that is the red flag you want to avoid. And in this case, you've got a company, some of this is growth, but I think they put out 2023 targets that say, hey, we're going to grow our loan book by 60% by 2023. Some of that's acquisitions, the lendcare, and maybe another acquisition to come, but they're still growing this thing really quickly. So when I see this quick growth, my first worry is, why is it not a red flag that this company is growing this quickly?
Right. I suppose that's a fair point. It's a very fair view. So the way that they've done it, and then I guess, one can form an opinion of whether it's a red flag or not. So before 2020, obviously COVID happened, and they were growing their loan books. I think, the 3 preceding years, they grew it at something like around 40%. And the next year was around, 50%. And then the year after was around 33%. That's in growth in growth in receivables. And yeah, they've been doing that as they're aggressively rolling out other branches. And otherwise, each branch also, is also pretty quickly growing their own loan books, right? And again, their average branch has about, $5 million in receivables right now. I think that number, was like $2 million not too long ago. And they're growing very quickly. And the company says that the cohorts are pretty stable. Like when you look at it, the way that they go, they move in a pretty stable, repeatable trajectory. And by the way, also like the stalwarts in the industry, they had like over $10 million. So that shows you kind of some of the opportunity that these branches can still mature. But yeah, so the way that they've been growing was organically. If you look at all their data, kind of everything else is fairly stable too. You look at their provision rates and their net charge-off rates. Provision rates were around 13%, for years, and they kind of stayed that way. Net charge-off rates were lower than that, and they were pretty stable as well. So I suppose there's nothing in the financials that would suggest to me that, something is awry here, and more so just, you kind of look at all the money that they're spending to open branches and the advertising that they're doing. I think they're getting a lot more customers. Like, again, this was a very starved niche, like in the non-prime lending market, right? So, I suppose that's kind of, my thinking. And then also, just during COVID, which was very interesting, and it also kind of shows how astute management was in handling this whole thing, is March 2020 happens, right? And the whole world stops and freezes. And so, you look forward to, this business, like, what did they do? So, they stopped lending and they put a halt on lending, which, by the way, this is a business when in difficult times, their liquidity increases because they have principal and interest payments coming in, but no money going out the door to originate new loans. So it's a good thing. Like, if you look in their investor deck, they actually have, like, if we had a pure runoff scenario where, like, we just had to, like, run off the book and sell it and let it run, they would pay off all of their debt something around 18 to 24 months in, and they would have money left over. Obviously that would be a bad outcome for the stock, but just like this is absolutely worst case scenario. Like they wouldn't even have to declare bankruptcy or anything. So, but so they reduced their originations by 50% year over year in 2Q. Reason being, they only wanted to lend to people who had like very secure jobs, like government jobs, very low risk of being fired, like high stability of income. They also had, and what really helped the results were, number one, obviously the social programs that Canada was running, which, was more generous than the US as far as, helping people get through COVID, writing them checks. If you have a kid who's in school, like, you get this, stimulus like every month. If, everybody gets a general like this stimulus, and that really helped people pay down their debt. Number two is the company, 2/3 of loan holders had insurance that they bought from goeasy. Before all of this happened. So when goeasy sells like their products, another way they make money is through, they have these ancillary products that they offer to you. And so one of them is insurance, saying, hey, like if something happens, if you lose your job, this thing will pay out your loans for, it comes out to about 8 months. So apparently 2/3 of the people said, okay, I'll do it. And so that helped goeasy too. And that's how their net charge-off rates and their provision rates. It's funny. It was about 13%, their provision rate before COVID. And now it's at, even before the lendcare acquisition, which is secured and has lower, that business, the charge-off rates went down to about 10%.
Yeah. A lot of the US players, I find this argument interesting where they say, hey, this is a little bit different than what you're talking about, but they say, hey, for COVID, their borrowers actually did better than they ever did because they got all these, they basically live paycheck to paycheck and the government was just sending them money. So their borrowers, in the US, a lot of them are saying, our borrowers are doing great, so great, in fact, that we can't lend to anyone because they're getting more money than they used to get. But the other thing that I thought was interesting that they've said is, look, our borrowers generally live right on the edge, right? So in distressed times, we actually don't see huge upticks in charge-offs because they're already living on the edge, they're living paycheck to paycheck, and restaurant work, a lot of them are restaurant workers, or they're jobs that don't really go away in financial crises or .com crashes. Whereas like a banker or something, a lot of bankers get fired. And if they've got some debt, that actually might be an issue because it takes longer to go find a new banker job or something. So I thought all of that was really interesting.
Andrew, that's an excellent point. I'm really glad you brought that up because I think that's also been maybe the biggest variant perception of this company and a lot of these non-prime lenders is that, people think it's kind of the framework. If you spend like a few minutes going through the deck, oh, they lend to these non-prime consumers. Oh, if a recession happens, they're done for, like they're toast. This business model is going to go under, but it's actually the opposite, right? These non-prime people, they are service industry oriented. They are, they are living paycheck to paycheck. But these people, they're perpetually living in a recession. And so historically, if you look at the data, great financial crisis, in Canada, there was an Alberta oil crisis in 2015, where a lot of people, got struck really poorly because of the oil economy. And even the .com bubble in the US, if you look back at those recessions, like the people who are living paycheck to paycheck, their charge-off rates, or in other words, their rates of not paying back their loans, let's say they increase 10 to 20% on a percentage basis from where they were before, right? So let's say like the average charge-off rate was 15% for these people. Increasing 10 to 20% means 15 turns into like 16, 17, 18%. Not much of an increase. But the guy that you mentioned who has like a job at a bank, he has like a really expensive mortgage, he has a BMW, he has a family of 4. If he loses his job, the data shows that their provision rates go up double, 100%. Yeah. Goes from like 6 to 12.
Or even if they went 3 to 5, right? Like if you go 15 to 17 or 3 to 5, 3 to 5 is a mammoth increase. Yeah. So 100% agree with you there. Let me switch and ask you regulatory concern here, right? Because anybody here, some prime lending is going to think regulatory concern. I think it's a little different up there, but you mentioned I think including ancillary products, their average interest rate is 40%. I think they say the average interest rate is 34% before that. I'm guessing the ancillary products are things like you're talking about, which are pretty high margin, the payment insurance that they can buy from goeasy and stuff. I'm not 100% sure there, but 40% is still very high, very high. It's not the payday lending 100% plus type APRs you're talking about, but it's high. I know in the US, 40% would certainly be a target for some type of cap. That'd probably be right at where they would be looking at cap. But I just want to talk broad strokes regulatory risk because a lot of listeners are domestic, US domestic, and Canada is going to have a much different regulatory landscape. So how do you look at that?
Yeah, that's a fair point. And yeah, that's right. Like in Canada, I'm sorry, in California, in the US, they are looking very recently at what, like 30 to 40% caps. I'm not too appraised of the situation there, but so there definitely are. And in Canada, the same thing, like provinces can have their own rules and laws that supersede, federal government. But yeah, so the federal government right now, their cap is 60%. I'm not going to say it's like not possible. It definitely is possible. If I had to peg kind of two risks to the company, one of them would be potential regulation. I mean, back in like 2017, 18, when this company was purely selling unsecured loans and, the APRs were between 36 and 60%, kind of like reaching the limit. Yes, like I agree that that would be like a much bigger concern. So now they've brought down their interest rates to kind of combat that to an average of 41%. They're introducing secured loans, right? It's funny, like they're very aware of this. They're extremely aware of this. Like when I did a branch visit once, and there was the person behind the counter with a computer, like kind of the manager of the branch, and like I was kind of peering over, and she had like a list of like potential people who called in or who are on the list for potentially getting loans, and like at the top, I forget what it said exactly, but something about secured loans was a priority. So I asked her, and the CEO was there too, and I asked, like, why is secured a priority? And I'm like, is that intentional? And they said, yes, like we're purposely pushing secured loans, which made me think, okay, so these guys, they're very aware that regulation could change at some point. And so they are, they're trying to, lend in the 20 to 30% range is definitely very safe, like, as opposed to like lending above. And even more beyond that, like, I guess my answer is it's potentially a risk, but also, payday lenders, they're definitely cracking down on even more, right? Payday lenders, like currently the law is if you're lending below $1,200, you can charge kind of whatever you want, but they're trying to find ways to crack down on that as well. And so, also if you look at other ways that they're trying to diversify, is they talk about goeasy's management talks about they want the customer, they don't want them to perpetually remain as like as a subprime or non-prime borrower. They're really interested in seeing them kind of graduate up the spectrum, both from the customer's perspective and from their perspective too. And what they're building right now, and kind of the next evolution of the company, you're going to see like the long-term vision, which is also going to very much help answer these regulatory concerns, is they want to become like a department store of products for anybody under the prime spectrum, which is not only the subprime and like the non-prime you see today, but like the higher non-prime and the near prime people. So like you look at several products that they're introducing right now, and by the way, like at a very fast pace, like not an unreasonably fast pace that it's foolish, but like Jason, the CEO, is putting his foot to the pedal all the way down and saying, hey, like like we're going to work as hard as we can to make this happen. They've in the past year, like they were talking about introducing an auto financing product, right? Which, so just as a little bit of an overview, in Canada right now, the auto financing addressable market is like $20 to $30 billion. Jason thinks a lot of that is mismarked, so it may be anywhere from like $30 to $50 billion. So about 80% of that is from dealerships, where like you go into your dealership and then you get financing on the spot, like a credit acceptance in the United States. 20% of the market approximately is peer-to-peer, where you just buy a car from like a friend or family or somebody on Craigslist. And so those 20% often they need financing. And so, they want to help target those people, say, hey, come into our branch. We'll pre-approve you for a car of like a certain like make, model, mileage, years old, and then you can go get that loan. So those loan APRs would definitely be like in the lower end of the range, and it would be secured against the car.
Let me just give one pushback, because
sure.
It sounds great TAM, but and I'm coming from the US, so maybe I'm off, but car loans are generally coming from banks in the US, and you can tell me if it disagrees, but I see them getting into auto lending, and I say, oh, well, that's secured. It shouldn't have run into a lot of the subprime issues, because it's secured, it shouldn't run into tons of the issues. Here there are some subprime auto lenders, but those tend to be on the really low end, really junky type of vehicles. So they're moving into this, and that's great. They're getting into a much bigger market, but I look at it and I say, what's their competitive advantage here? They're doing secured lending against the car. At some point, aren't they competing against banks with much lower cost of capital?
Right. Yeah, they don't have a competitive advantage. It's another, like right now, yeah, they don't have a competitive advantage. Again, like, because I think if they were competing in the dealer side of things, that is so competitive. And I'm not saying that they're better than like a credit acceptance in the US, for instance. Like, no way, they've been doing it for 50 years. I'm not saying they're better than the banks. I think right now what they're trying to do is just focus on that 20% of the market. So maybe, it's like 6, 8, 10, $12 billion. And then eventually, they haven't done this yet, but maybe partner with some dealerships who are interested in making like chains, like dealership chains who are interested in making goeasy like the preferred partner. But you're absolutely right. Yeah, there's auto lending. People have been doing this for many decades, and it's a tough thing to crack. So, yeah.
Let me turn to, we've mentioned most of the pushbacks, but actually when I was researching this, the biggest pushback, and I kind of mentioned this at the beginning, but I think it applies to broader strokes. I look at the company and I say, great, 30% earnings growth for the past 2 decades. Management seems great, very aligned, astute capital allocation, as we've talked about. There's always a bigger market to lend to. When you start talking TAM, it's always bigger. But 6 times price to book. They just did an acquisition, so the trailing numbers are a little funky. But it's probably 25 times normalized earnings run rate, 6 times price to book. Yes, the return on equity metrics are great. Yes, the return on asset metrics are great. But this financial trading at 6 times price to book, 25, 30 times earnings, your job, my job is ultimately like make alpha in the long run. It seems pretty pricey. How are we going to make alpha in the long run from this?
Absolutely. That's a great question. And look, I've been very interested in the stock since it was at $40. It's now at almost $200. So certainly it's run up, but that also means like, future opportunity is a bit obscure. Like I remember, back like just a few years ago, it was, I had it trading at about 8 times normalized earnings and it's growing at, 30% a year. And, it was definitely a very high conviction pick, and it still is. And I'll tell you why. So today it's trading at about, because I have it at about 20 times, normalized earnings for 2021. So you can call it half a year forward. Normalized earnings, and that's excluding the gain on investment they've had, but including everything else, and to reach a normalized number. And I have it also, so management recently they put out their 3-year forward targets, and like if you look historically, like they put out 3-year forward targets often, and just about every, if you look back after like 2 years, 3 years, they've just blown away whatever targets they put out. So they've been very conservative in nature, but taking it at face value and kind of trying to get there organically, and you can see an easy path is, they think that they can grow, gross receivables are going to be about 2 billion at the end of this year, right? And that's going to yield true free cash flow, which they put out a new metric of, which I think is very smart, of like cash from operations before net originations to grow the book, which we can kind of break down. But that number, I think this year originations are 2 billion, and that kind of operating cash flow number is in the high, like 160, 180 million or something like that. In 2023, I guess they're digesting this lendcare acquisition, which, by the way, if after synergies that they're realizing, but more importantly, they only paid like 17x for this business, growing earnings at like 40-50%. They paid 7 times 2023 expected earnings for it. Even if they're off, if it's like 10, 12 times, like they really got a great deal on this acquisition. So they think that in 2023, they're going to have receivables of $3 billion. So, what does that imply? That implies growing the loan book at about 20 to 25% a year for the next 2 years organically. And remember, before COVID, they were growing the book. In 2019, they grew their book at 33%. The year before that, like around 50%. They've been growing it at these very high clips, again, through opening branches and just organically, getting more customers in. And now they have this lendcare acquisition they made, which they had a $400 million book, and they grew that at between 45 and 50% over the last 2 years. So, and by the way, so lendcare, they do secured lending for power sports, things like jet skis, motorboats, things like that. And so they added a few verticals there, just very quickly. So anyway, like, can they grow their originations, receivables 20 to 25% for the next couple of years? Basically, if it looks anything like the past, I think they will. Management has a ton of credibility. They've executed time and time again. Would they really make these way, overachieving forecasts at this point? They could be getting ahead of their skis. I think it's reasonably likely. So anyway, if they reach like the originations targets, and then you do the math of like the yields and the charge-offs, et cetera, after that, you get to around 12 times normalized earnings 2023. As in today's price is about 12 times normalized earnings in 2023, right? And I have that number around like $270 million in normalized free cash flow. And then you look from there, and what's going to happen after 2023, right? Like, you're already paying 2.5 years in the future for those kind of earnings, and that's a great question. right, Andrew? And the original business, it's getting bigger. Their addressable market's about $45 billion in Canada, and that's anybody who's non-prime, and that's all loans below $50,000, which are the two camps that they play in. And so how do they go from here? If you take the organic business, I would peg it maybe call it 8 to 10% organic growth, looking forward the next 7 to 10 years from there, right? Like they are getting, they're only about 3 to 4% of the market right now. As far as their secured loans, if they double that, then, is growth going to slow a bit to the teens maybe? And then looking at 10 years, you always want to be super conservative if you're going to look at that far. I look at 7 years, max, which is still pretty far to be confident about a business. But, so let's say they compound at 8, 10% a year, after the 12 times earnings number, fine. I would bet that it's going to be higher than that, maybe significantly higher than that. And this goes back to management. So you already look at the last 2 years, they've introduced, the auto lending product to expand. PayBright, by the way, which they've entered the point of sale, buy now, pay later segment themselves. So they took, just everything they've done has been kind of right so far. They took a $34 million stake in PayBright, which is a point of sale online solution, right? So you have, which by the way, got acquired by a firm, and then a firm went public. So goeasy had shares in PayBright, which turned into shares of a firm, which turned into a firm's stock price. And then, by the way, when a firm was it reached 130, 150 at some point early on, they actually did a total return swap at $108 or so. And then the share price went down to 50. So they've done everything right so far.
There was some discussion on, I think it was the Q2 earning call or something. And I saw them say all that and I was like, damn, these guys are good traders. I was kind of doing all that math in my head. Yeah.
Like maybe they should be running a fund.
Yeah, right. That's where the real growth's going to come from. They're going to run this will be the side business, and they'll just run a firm trading hedge fund.
Exactly. So that was really, they turned 34 million to $112 million. But it wasn't about the investment. It was more about again, thinking about how, they're thinking very astutely. They enter this business where a customer, let's say they go to one of these websites like wayfair.com in Canada, right, which a firm has a relationship with, and they want to do buy now, pay later installments, right? But typically, before there was a partner like goeasy, and by the way, there's only, he said you can count on one hand the number of non-prime buy now, pay later point of sale partners in Canada. So goeasy is one of very few. I guess Kira maybe another one. So you take this customer, they go to wayfair.com and they want to buy a product, and if they're prime or they're good enough credit, they can get those 4 installments at 0% interest. If they're non-prime, if there's no partner who can underwrite that, because the company doesn't want to underwrite that, or a firm doesn't want to underwrite that. They don't have the data, they don't feel comfortable taking it on their balance sheet. They now partner with goeasy. So then the customer now will say, okay, you can actually qualify, it might be a 12-month loan. It might be 20, 30%, APR, but if you want to do this, we can do this. And then goeasy will take it. So they make money there. The main reason was they wanted cross-selling into their goeasy products, because once the customer, is gets that loan, they're in goeasy's ecosystem and they can get emails and marketing. So he also said that the cross-selling advantages were about 25 to 30% higher than expectations, right? So anyway, going back, closing the loop, that's an example of something they're doing expand their TAM and increase the revenues. Also, I don't know if you saw, I'm sure you did, they have this past quarter, they took an interest in Brim Financial, which is a startup credit card provider, partnering with MasterCard. And I'm sure the conversation maybe has something to do with, Brim wants to offer their credit card to non-prime consumers, but they're younger. They don't necessarily want to take the risk of underwriting to non-prime consumers. They don't have experience doing it. And where goeasy is kind of very interesting, kind of long term. They have their customer facing Easy Financial brand, but lendcare, they're going to use the lendcare brand and do the back underwriting for that. They have a firm where they're going to do the underwriting for that, but they don't have a consumer facing. Now Brim Financial, they don't even need the brand. It's Brim Financial's credit card, but they're doing all the underwriting in the background because they're just simply one of the best in the whole country at doing this. So going forward, it's you think of how they can just become as the CEO says, when a prime customer goes into a bank, they can do anything. They can get a bank account, they can get a credit card, they can get a loan, they can get a mortgage. He wants to be that kind of company for non-prime consumers. They can go in, they can get an unsecured loan, they can get a secured loan, they can get an auto loan, they can get a credit card, they can have, point of sale finance, they can get jet skis and power boats, anything that they want. And so when you kind of think about a $45 billion TAM, right, as far as, your receivables, they only have $2 billion in receivables, they'll have maybe 3, and it's still very fragmented beyond that. how many different avenues can they execute? And that's where you do need, a lot of people, they think any trusting management in any way, shape, or form is a leap of faith. And I can't fault them for that. There's it's to each his own. And, I firmly, have a lot of confidence in this management team. And again, they have a ton of skin in the game. Their incentives are aligned, like to compound, earnings per share, probably one of the best metrics possible. So that's what gives me confidence.
And they've proven it over the decades too, right? Like this is not a management team that's getting a 30% earnings per share target for the first time. It's a management team that's done it for 2 decades at this point. No, and then I guess the only other thing I'd add to your TAM thing is like, with the subprime consumer, it's going to be generally smaller dollar loan values. And the great thing about this is like one of my first principles I keep coming back to is time and time again, you are seeing you want to be invested in the company that owns the consumer, right? And in this case, this is a consumer that's probably a little bit harder to reach because they're subprime and you can't spend as much. Chase, they can blanket Sapphire, they can advertise at the US Open for Sapphire customers and stuff. You can't do that here. goeasy, they've got actual physical storefronts. I just think they've got a real customer acquisition advantage, and that kind of wraps into the whole thing you're talking about. Let me ask one more quick question, and then I'm going to let you wrap it up with final thoughts. Longtime listeners will know I'm a stickler for this type of stuff, but lendcare, you mentioned they got a great deal on lendcare, and that raised 2 questions for me. A, how does any company get a great deal on an acquisition? And then B, this was $323 million deal closed in April. The founders are all staying on. And I noticed on the call, they said, hey, the founders are staying on and they're so confident they're rolling some of their equity into the company. They're going to take 12 million of equity in goeasy. And I looked at that and I said, well, they're cashing out for 320 million, 12 million of equity isn't, exactly a huge vote of confidence. So, and I'll let you give the pushback. There's obviously pushback to that thought, but it's always something I'm a stickler for. So how did they get a good deal, and why, if the founders were so pumped up here, why didn't they kind of roll a little bit more equity?
Yeah. Did they say how much equity the founders actually had to begin with? Like
that's a good question. I in my head, I think I naturally assume their founders, they're cashing out for 323 million. They're getting the vast majority, but it's very possible that this was a finance company. They raised a ton of outside capital, and they got 20 million in the sale, and they're rolling 60% of the proceeds. Right. So I do not know the answer to that.
Yeah, no, it's a great question too. And the other thing I wonder with the whole structure is like it was private equity owned when before goeasy bought it. So maybe private equity had something to do with when they bought it from the original founders, how much of the flesh they wanted to keep. And anyway, no, but it's all a good question. I will say, as far as back to one of my 2 risks, one being regulatory, 2 being kind of management's been driving, at 90 miles per hour. It's all been great so far. Can they hit a brick wall at some point? And, maybe like the incentives of compounding earnings at a high rate, like could that lead to not necessarily like bad actors like at all, but just more like, you get in over your skis or you get a little bit too optimistic about things. Like this could be an example, right? I mean, they did acquire it. Like why did the company sell for, less than 1 times book, it seems, or it might not be less than 1 times, but I did the math and it could be around like 1 times book. And because they paid 320 million, $400 of loans, but how much they didn't release like the balance sheet, like how much was the debt, equity, other liabilities.
We can even forget about book. You mentioned the multiples early, right? You're talking low teens multiples on near-term numbers, maybe approaching single digits on 3-year out numbers, right? Like that's a very cheap multiple especially for a company growing this quickly. And the company said, goeasy says we got a great deal, but it raised the question, this company's growing quickly. They know their value. Why are you getting a good deal when you look at all of this?
Right. And $400 million of loans to yield $20 million in earnings, right? So obviously there's more math than that, but roughly like 5%, add back whatever interest, but maybe it's not a terrific business. Those are definitely questions, that I have outstanding and definitely want to address with the company. I totally agree with you. They're at the top of my priority list, kind of, lendcare, and then also, Brim Financial, kind of what the vision is around there. So yeah, it's very possible. Again, like, it's the only other kind of saving grace, maybe they know it's not a terrific business. And I'm just kind of, speaking maybe for my own thoughts, maybe it's not a terrific business and it just allows them to get into more verticals. But the fact is, like, you buy a mediocre business in a few years, 7 times earnings, after like all the, everything's realized, maybe that's going to be accretive to economic value, and that's okay. Again, like it would kind of, at least at the very least, what I hope is not the case is if it's a business with mediocre economics, is that it also doesn't have like a bad customer brand, right? Because goeasy, in this business, you can't build like a great brand. You can't build a brand with like a 90 NPS that everyone's gonna brag about. Like it's people in desperate times, but as long as they're not like screwing over the customers or anything like that. So I think it's a good point, Andrew.
Cool. Well, hey, Jon, I want to give you the last word. Actually, my last question had been, you said there are two risks. One was regulatory. What's the other one? And you mentioned it. You said they're driving 90 miles per hour. And that kind of goes back to the scariest thing is a fast growing financial. But I want to give you the last word. We've covered a lot here. I know anyone who's listening can tell you've done tons of work on the company in the background here. Is there anything you wish we had hit that we didn't hit? Anything you think we should have hit harder? Just any lingering thoughts you had here?
Yeah, sure. No, I really think we hit a lot, Andrew, but, just a couple quick things. One is, really a lot of the variant perception here is, or I should say the bear cases that people I've heard along the way, bear cases, misconceptions, kind of caution, has been over like these non-prime customers and what we already talked about, the fact that they, are more resilient than people think, kind of the biggest misconception I've heard from other investors, or it's not a misconception, it's just a caution, is okay, so goeasy, like they have, they kind of started this business in 2011. Yeah, they had that blip in Alberta, but they haven't been through a real crisis. They haven't been through a real recession yet. And so, yeah, this data from like 2001 and 2008, that's great that non-prime people are resilient, but how do we know goeasy's customers are going to be resilient, right? And I just think like, the past financial crisis or, the past crisis / COVID, in my mind, just totally debunked that myth. I think that, they made it through. Their charge-off rates on a net basis, they decreased. And, the CEO, he made a comment kind of offhand that even if the insurance product had not existed at all, which, did help them, because my question was, okay, but what if you didn't have this insurance product, right? Like next time, let's say your insurers like don't want to give you access to these insurance products like that cheaply for your customers, and therefore take rates are going to go down, or it's going to be more expensive for them. And then you don't get that saving grace. He said that, I think it's a combination of the business resiliency and then also, the social programs in Canada, their charge-off rates were still lower than 13%. They were still lower than what they were pre-COVID. So, I think like, basically also like keep in mind, like, their pre-tax margins are 22%. And their charge-off rates are 9%. That means for the company to break even, not even lose money, just break even in some crisis, like on nothing like we've seen before. So like at least multiple times worse than COVID, like the charge-off rates would have to go from like 9% to 31%. Right. And that's probably unlikely as far as like resiliency of the business model. So my point there is I think this has been a debunked myth almost entirely,
And this might be bringing my politics a little bit into it, but I mean, I just think politicians have seen, especially in COVID, like when there is a crisis, just bail everyone out and you'll keep your job, right? Like, right. But I kind of agree, like, especially in COVID, but, during a crisis, I want to see checks out the door. And I think politicians have gotten the memo. People do not care about debt at all in general. Maybe that's right. Maybe that's wrong. But in a crisis, people especially do not care about debt. And in a crisis, I think going forward, we just see there are just checks going out the door, which is probably a big benefit to them. I don't know if that's too crazy or too political. But
no, it's something maybe I didn't quite like want to say necessarily, but you said it. And so I kind of agree. Like
we opened that Pandora's box.
We opened the Pandora's box. Like long term, is it maybe fair to change the thinking that in crises, like the government will to some sense provide assistance to the average person, which will help, the non-prime lenders, from seeing the customers charge off? I think it's a very fair assumption.
And I mean, if government isn't there to provide assistance to the average person when they need it, like what is government there for then? I don't know. Again, maybe too political, but
I guess just one other thing, just really stressing kind of the long-term vision here, like, and to add one more point, like, again, like people see this company, right now in Canada, like they're the leader at what they do in unsecured lending, and they're branching out. But there really is no company that exists like providing like a department store of all sorts of financial products for people under the prime threshold. No company exists. goeasy wants to be the first to do that. And, if they do, I think it's only going to increase, their moat even further. I think it's, they already have like kind of the brand power that I talked about, that barrier to entry, barrier to success. And, the data that they've gotten, like if they add all these products and if they all succeed and they get market share, obviously, penetration in the TAM is going to increase, like revenues, profits will increase, but also the staying power of that brand. Like if you are a customer and you're near prime, right? Like your high non-prime, low non-prime, subprime, and you go to any of these one products that they have, and they might have they're gonna have at least 5 or 6, by the end of end of next year. And who knows what they're going to innovate even more. And then if you're in that ecosystem and you have a fine experience, and they can charge you lower rates than anybody and give you more options, just you can see how the flywheel just really starts going. And and the opportunities are kind of endless. And then two data points there is, one, the near prime segment, the near prime TAM, meaning kind of in the 600s, let's say you're below prime but not too far, that TAM is about 2/3 of what I'm talking about. So if their TAM is 45 billion, the near prime is about 30. Right now, they're kind of almost entirely in that 15 billion TAM. So what they're trying to conquer and unlock is they're going to triple their TAM basically from what it already is and what their numbers already reflect. So that's important to understand.
And if you get near prime, you can probably start offering, hey, we've got this customer, we've got near prime. You mentioned credit cards, but you could probably even start saying, hey, we're going to do maybe not mortgages, but investment products. At that point, you're probably starting to look at investment products. So there is a lot of kind of bolt-on opportunity there.
Yeah. You should talk to Jason, the CEO, and give him some suggestions. I'm sure he'd appreciate that. And I guess the other thing is also, they have mentioned international M&A is very much possible. In fact, I was kind of surprised, they had a big kind of M&A that, they have been speaking about for quite a bit now, for a couple of years. So lendcare happened, which was national, which is not, it's not what they've been talking about. But I think they've been saying opportunistically, they don't have a set hard timeline. He's really made a point, we're not going to do it for the sake of the numbers. We're not going to do it for the sake of doing it. But we really do think, we've done our research, and there's other, developed nations with similar profiles, like the US, UK, I think Australia, he mentioned. Those are the 3 countries that, come to mind, definitely the first 2. And that, there is still kind of a large niche and a large TAM of non-prime customers who are underserved, who kind of don't have, who don't have access to, to these products that we're offering. And, their alternatives are not as great. And again, that if they cross that bridge, it'll be time to kind of analyze it as it comes. But it's just another also potential source of, if you trust for them to make smart decisions, maybe it will be another huge source of value creation.
I think that's exactly right. You worry, it's a Canadian lender, and the history of Canadian lenders, or anyone international lenders going into any M&A and into any other market, is pretty poor. But that is a place where you would look and you'd say, hey, these guys, they've got a lot of skin in the game. If they're doing it, it's because they believe in it, and their track record is really good. So that's where you come. Anyway, Jon, I've actually got something coming up. So this has been great. We've run a little bit over time, but I've really enjoyed this. Anyone who wants to learn a little bit more about Jon, I'm going to include the link to his Twitter handle, because Twitter rules all. It'll be in the show notes, so please follow up with him from there. Jon, this has been great. Thank you so much for coming on.
It's been great. You're the best, Andrew. Thanks so much.